How banks actually make money. You deposit $1,000 into a bank. The bank pays you interest. Then it lends money to businesses and individuals and charges them even more interest. So how does this business actually work, and where does the bank's profit come from? Let's start with your $1,000. When you deposit money into a bank, you still see that $1,000 in your account, but from the bank's perspective, that deposit is a liability because the bank owes that money to you. At the same time, the bank uses its balance sheet to provide loans and make investments. This is where the bank's business model begins. Banks connect people and businesses that need money with the money available within the financial system. One of the biggest sources of bank income is interest. Imagine a bank provides a $100,000 loan and earns interest from the borrower. At the same time, the bank may pay interest to customers who keep money in savings accounts and to other sources of funding. The bank tries to earn more from its assets than it pays for its funding. That difference is an important part of what is known as the net interest margin. But banks don't make money only from loans. They also earn fees from credit cards, payment services, account services, foreign exchange, investment services, and many other financial products. Large banks can also earn income from investment banking and asset management. So a bank's business is much bigger than simply lending money and collecting interest. But there's an important catch: lending money is risky. A bank can give someone a $100,000 loan, but the borrower might fail to repay it. That's why banks assess borrowers, set interest rates, require collateral for many loans, and set aside money for potential credit losses. In other words, interest income is partly the reward for taking financial risk. Now let's address one of the biggest myths about banking. Do banks simply take your $1,000 deposit and hand that exact $1,000 to someone else? Not necessarily. Modern banking is more complicated. When a commercial bank makes a loan, it can create a new deposit in the borrower's account. In simple terms, the bank records the loan as an asset and the new deposit as a liability. But creating a deposit doesn't mean the bank has created free wealth. The bank still has to manage liquidity, capital, regulation, funding, and the risk that the borrower won't repay. So where does the profit actually come from? A bank's business is essentially about managing money, risk, and trust. It earns income from loans and investments and can earn fees from financial services. But it also has costs: employees, technology, branches, funding, taxes, regulation, and loan losses. After paying these costs and absorbing losses, what's left contributes to the bank's profit. So the next time you put money into a bank, remember, your bank isn't just storing money. It's operating a massive financial business built around lending, investing, payments, risk management, and trust. And the bank's ultimate goal is simple: earn more from its assets than it costs to fund and operate them. That's how banks actually make money. Follow for more economics in 60 seconds.